Greetings traders. In today's video we will have more, I would say, practical approach, because here I'll be showing you examples of price action trading approach, and we will see lots of ways how we could actually set up and correctly position trades with this trading approach. Because funny thing is that although price action trading might be one of the most popular, if not the most popular trading approach, but it actually doesn't have one strict definition, as opposed, for instance, say trend following, where we actually know pretty well what that means. So here we have lots of interpretations, but key thing is one, we are primary concerned with price action rather than, for instance, fundamental analysis to understand where markets are going, or to be overwhelming depending on market indicators. So price action is the name of the game here. So let's see how in practice does it look like. Now, if we are looking this as purely from practical standpoint, we have to see how we could actually stack our entries and position our trades. But approach actually here is really simple. You have two ways how to trade. You could either trade within specific range and support and resistance lines and make money with that time frame and with that range, so you have tight stop losses, and really those trades will have short duration, or an opposite direction. You might have trading approach where you are going to rely on price breakouts. So that means, as opposed to that approach where you have constantly small losses and small profits, you probably will have way less trading signals. Most of them will be false, but once you make some profits, you will make huge profit out of that one profitable trade. I personally employ second approach better, but it's up for you to decide. But now I'll be showing you how to trade both of them. So let's have charts on and let's see how actually we could stick it all together. Now we have S&P 500 chart, and I actually have shown this on daily chart, and actually I have put there Fibonacci levels. Why Fibonacci levels? Because they work really well as a support and resistance indicators, and here I'll be able to show you both of these price action approaches, both from range trending and from breakout trading perspective. Well, I would say let's improve this slightly and let's narrow it down to shorter time frames. So now we have daily approach. We have daily approach here, and we could actually use this in this way. So here, for instance, you could see here was the lowest point, here is the highest point, and here we could see actually how markets trade with range markets. Here, for instance, we are between third and fourth level of Fibonacci. I don't use those percentage points because it's really silly to pronounce them, so forget me about this. But nevertheless, here's the support and resistance lines, and you see markets are moving with that range. So that means you could easily spot orders here and trade within here. Or option number two is trade with price breakouts. So prices are breaking down on the lower side, so you could go short here, or once again they are breaking up on upper side here and here. But the funny thing is also they almost always reach Fibonacci levels. So trend lines and support and resistance lines have multiple approaches. Here also they work as a support line, but now they are as the resistance lines, because markets move from one bracket to another bracket, first bracket, and then to this bracket again. And then also markets had some retracements, some bullish patterns. Here they moved more or less in the range, but that range still also was within support and resistance lines from Fibonacci, and then they broke up higher and they had wonderful trend entries. So this is how actually price action looks like within support and resistance levels from Fibonacci levels. So I'm not selling this strategy as Fibonacci levels, but I'm simply showing you that it could work, because I could draw that with my hands. I could draw a trend line, I could draw support and resistance line by my hand, and it could be sort of similar, but I'm too lazy for that to do it, and there is no point of that anyways. But here, simply for me, is to show this point. We could work from the range trending perspective. For instance, in this range, or in this range, we could trend from the support line to resistance line to support line. Then prices break out, we might go short, take profit levels at another key Fibonacci indicator. Then markets could reverse, they might cross Fibonacci levels again. So here we might decide, depending on our strategy, to take action at either direction. Here it didn't work either of these directions, hence we had to have risk management, but then fell again, made price breakout, reverted, and made upper moves again. So it's not white or black answer. We could either trade to put here stop loss and actually go short, go here and wait for prices to break at upper levels and go long. So these levels could be used by both approaches, by both ways. But key is to understand these levels exist, to understand which way you are choosing and to choose correct risk management approach. Because as I'm always saying, entries are not important because from both of these approaches, whether you are trending within range or within price breakout at one direction or other direction, you will have trading opportunities. But risk management will be the one which will determine whether you will have money in your account or whether you will lose it. If you want to know how to do this properly, I strongly suggest you to join my Telegram channel, because here I'll be showing you lots of examples of price action trading, not with Fibonacci levels, but also with moving averages, with Bollinger Bands, with support and resistance lines. I'll be showing you how to trade for range trading and both for trend and breakout trading from price action perspective. And you will see live trades, live trade analysis, and of course you will get trading signals. And all of that will be for free. So all you have to do is click on the link below the video, join my Telegram channel, and make money together. But now let's move on and let's see another critical opponent to any price action trading strategy. Now, once we are here, we have to understand also how risk management and position sizing works. So key, as I told you before, key here is to understand how to put your stop losses, how to understand your risk and rewards, and how to actually employ correct position sizing. So what would work in practice? For instance, if we are decided to trade within range trading, that means, for instance, we see that markets are been testing support lines. So that means we are going to go long and take profit levels here. And naturally, we have to put stop levels somewhere here. So that means initially our stop loss levels should be probably at middle of Fibonacci lines, and they have to be twice as low as take profit levels. So that means we will make twice our initial risk once we have take profit levels. So if we are going to be right 50% of the time, we will have reasonable positive expectancy. And depending on how many markets you trade and what's the duration of trades and volume of trades, you have to see how much you will risk per trade. Because if you trade S&P 500 only on daily charts, you could easily risk a couple percents per each trade. But if you are trading like 10 markets within 30-minute timeframes with this approach, you probably shouldn't risk more than like 0.5% per each trade. And that even might be too much because total volume of trades will be really high and you simply have to understand how much you are going to risk there. But here, the idea is simple. Usually put stop loss within reasonable trading volatility. So that means if markets are moving, for instance, around half of the Fibonacci levels, that means you are placing your stop loss at that level. And just as I told you, place your take loss profiles from one range to another range at Fibonacci levels. So that then you might have something. But if you are using trade breakouts, you might consider to put trailing stop loss levels and take profits could be way higher. For instance, if as opposed to range trading, we are choosing breakout trading and prices broke out upwards, we of course are placing our stop loss below major Fibonacci levels. But then our take profits should be as high as here. For instance, what we might do, we might put initial stop loss there, but once markets moves along and they are crossing even above next Fibonacci level, we simply could lock on the profits and we could move accordingly our stop loss along with the price line. So that means we could actually make money right up until the last Fibonacci level, and our stop loss will be following us as well. And when prices eventually reverts, we probably will have stop loss someone here, and we actually made money through all of this move. So here we don't know whether the price trend will end here or it will end here. So that's the different approach. And simply, here's what I would say. If you are trading price action strategies with range trading, use tight stop loss, which is probably 0.5% or half of your initial take profits. But if you are trading breakout trading, remember your average profits should have at least 1 to 5, 1 to 10 levels to your initial risk. But here you have to wait for markets to develop themselves. So you have to put that trailing stop and it will work better because here you are betting that markets will make extended moves and you don't simply know where it ends. So either take profit levels at really, really high levels, like at least 1 to 10, or simply adjust your stop loss, act accordingly so you are always fixing some of the profits and you have way less things to worry about in this life because your take profit and stop loss levels are set correctly. And this is how practical price action works. Simply take any indicator. Do not always take Fibonacci levels because that's not the best indicator. It's simply one. It's easy to use and easy to understand indicator if you want to see market analysis and some strategies. It wouldn't make a difference whether you use Bollinger Bands or Fibonacci or any other indicators. So use one of the indicators, understand where are support and resistance lines and where might be price breakouts. And then to decide whether you want to trade on the breakouts or on these support and resistance lines. Once you understand that, put stop losses and take profits, act accordingly. Or in other words, have tight stop losses and tight profits, which has to be twice as big as stop losses with your range trading. But if you are going to breakout trading, don't use stop loss levels at all and just simply put trailing stop loss levels or place stop loss levels at really high levels, for instance, which is like 10 times higher than your initial risk. And this is working for breakout trading way better. So these are two approaches with practical price action trading in your mind. So if you want to see additional information about that, as I was saying, join my free Telegram channel and of course continue to watch my educational videos on different trading strategies and approaches. Thanks for watching this video. Bye.